Welcome. We hope that you're staying safe and healthy. The Mortgage Bankers Association of New York, an organization whose membership is made up of community and national bankers, credit unions, independent mortgage bankers, and all those service providers that support the residential and commercial lending industries, such as title companies and appraisers and environmental companies and lawyers and so many more, is here to we're dedicated to assisting consumers in attaining and maintaining homeownership, as well as succeeding in business and commercial real estate ventures. We believe that this webinar will provide you with some necessary information so that you can make intelligent and appropriate financial decisions and better understand your rights and obligations with respect to making your mortgage payments during these unprecedented and stressful times. Joining me today is Sarah Singis, Director of Loan Administration at the Mortgage Bankers Association. She works directly with lenders and servicers, as well as lawmakers and policymakers in Washington, and has been working tirelessly to help everyone understand the rapidly changing economic environment. Also, we have Aubrey Close, Regional Director of National Credit Care. Aubrey is here to provide us with insights into your credit profile and how to manage and maintain your credit rating while navigating the current environment. As many of you are aware, Congress passed the CARES Act this March. The CARES Act is intended to address the economic fallout of the 2020 coronavirus pandemic in the United States. Sarah, what protections regarding making mortgage payments does the CARES Act afford consumers, and who is eligible for those protections?
Great. Thanks for having me. So the CARES Act has three main provisions that sort of protect consumers who are struggling to make their mortgage payments. One is a moratorium. It forbids foreclosures to proceed during a period of time. It contains some important credit reporting protections. And then what I think is on a lot of people's minds these days, it contains some requirements for borrowers to be able to request forbearance if they are struggling to make their mortgage payment as a result of the COVID virus, whether they are impacted physically or health of family member, or if they are impacted in terms of having job reduction or even job loss. So the forbearance that's provided under the CARES Act, it is a borrower can request up to 6 months of an initial forbearance period, and then if they are still struggling after that, they can request an additional period of up to 6 months. And that doesn't mean they have to take a full 6 months. In fact, it's better to start with shorter, separate periods, and they will still have the ability to get extensions up to for a total amount of 12 months. There should be no documentation required other than perhaps an application or an attestation that they are indeed suffering from a COVID-related hardship.
Sarah, I'm going to interrupt you there because I think there's confusion in the marketplace as to who you make that application to. Can you just take a moment and discuss the role of the servicer, the mortgage servicer, in the forbearance agreement scenario?
Absolutely. Well, first, it's important. One thing I failed to mention was that the CARES Act forbearance provisions only apply to loans that are federally backed. So that would be a loan that is either insured or guaranteed by Fannie Mae, Freddie Mac, FHA, VA, or rural housing. So those are the only group of loans that have that CARES Act forbearance. Other loans that are not associated with these agencies may still be eligible for forbearance, and they would follow the same steps, and that is to reach out to their servicer. Now, the servicer is the organization, the company that the borrower makes their monthly payment to. So it should, the name, the contact information would be on your monthly billing statements or on the servicer's website.
Well, the good news is that we are seeing servicers who do not service the governmentally insured loans also taking active roles in helping people mitigate the current situation under the coronavirus scenario. So that is a
Absolutely.
positive. But what I'm hearing is that you must contact the servicer and not necessarily the original lender from whom you received the loan, because only the
Exactly.
servicer can make that decision. What
Exactly.
question should a borrower ask a servicer before making the decision as to whether or not they want to enter into forbearance? Um, Such as you discussed a little bit, the terms of the loan, the amount of
Mhm.
time that somebody can get the loan for or the forbearance for, but also what are the issues that a borrower needs to address before opting for forbearance?
So I think it's important for a borrower to talk to the servicer about their current financial situation, and the servicer can help them determine what the most appropriate starting period of forbearance is. But also, borrowers should certainly ask about what happens at the end of forbearance and what options will they have for repaying the missed amounts. So it's very important for borrowers to understand that these payments during forbearance are not waived or forgiven. You will owe the money, and you will have various ways of repaying that amount, but it's important to get a sense of what those methods of repayment will be. One
Um,
more thing, actually, sorry, that I think it is really important for borrowers to ask is whether there will be any impact if they do take forbearance, impact later if they are planning to buy a new home soon, or if they may want to refinance, whether there will be any impact from taking the forbearance.
Sarah, there's been considerable confusion about whether borrowers are going to have to repay the amount that is forborne
Yeah,
um, immediately in one lump sum or over time. And for several weeks, the industry was in a bit of a quandary as to how even to advise consumers
right.
this play out. But this week, and I'm going to say this week, because of some of your efforts, we received some good news from the government. So I'm going to let you just describe what we got this week from the policymakers with respect to forbearance repayment.
Yeah, great. Yeah, you're absolutely right. I mean, unfortunately, some borrowers have been told that they will be required to repay the entire amount immediately, as soon as that forbearance period ends, and that's really discouraging and scary for a lot of people. So if you have a federally backed loan, again, one of those loans that make you eligible for the CARES Act type of forbearance, then you will absolutely not be required to repay in a lump sum amount at the end of the forbearance period. And that was made even more clear a couple of weeks ago. The Fannie and Freddie released scripting to help their servicers talk to borrowers. The scripting really emphasizes that there are multiple options at the end of the forbearance period. If a borrower chooses to repay in lump sum, and if they are able to, that's fine, but they are not going to be required to. And then FHFA recently came out this week with an even stronger statement to make it absolutely positively clear that lump sum payment is not required at the end of the forbearance period.
I think that was a big deal. Aubrey, I'm going to turn over to you for a minute because as we're talking about putting loans into forbearance, which means actually telling people they don't have to make a monthly payment at this particular time on its particular due date, how does that get reflected on a credit report, and does it have a negative connotation?
Thank you, and thank you very much for having me. So being in forbearance is not technically derogatory or negative to your credit. It's late payments that are. So what's again most important is just knowing the date ranges so that you don't have you don't have any late payments at all. Moving forward, that's the most important from a credit standpoint. But being in forbearance is not technically derogatory.
Okay. Well, let me ask you a question. During these times, people are concerned about being able to make payments, but they're also concerned about maintaining their current credit ratings, so that they have the ability to do certain financial transactions moving forward. What's your advice to people now in this time with respect to making their payments, negotiating other methods of forbearance or otherwise?
Well, I mean, it's a common question that I receive, and first and foremost, I always recommend, if you can pay your bills, you should. If you can pay your mortgage, you should. You should not enter into forbearance. That's first and foremost. If you can make your payments, you should. You should make all of your payments on everything that reports to the credit bureaus. To start, everything that reports to the credit bureaus, you should definitely continue to make your payments on. What's most important for people to know is being late on anything. The next late payment you have on anything, be it a mortgage, your auto loan, your credit cards, the next late payment you have on anything is the worst thing in your credit report. So that's first and foremost, as people understand, if you can make your payments, you should, to avoid any forbearance confusion, and those fees at a later date. If you can make your payments, you should, and definitely you should not be late on anything moving forward. If you've got to, add on a little bit more credit card debt, through in the next 2, 3 months, 4 months to come, then that's what has to be. You can always pay your credit card debt later, once you get caught up. But having late payments, that's the killer, and that's what's going to dramatically lower your credit score, and obviously relatively preventing you from doing any mortgage business or any business at all.
Just as a follow-up to that, once somebody is out of forbearance, how is that denoted on a credit report? Is it something that will be a stigma attached with their credit report moving forward?
No, it's just during. The verbiage is applied to the trade line, or the account during. But once you're back into repayment, then it's no longer applied, like deferment. But student loans is very common. Student loans can commonly be in deferment, but once you start making payments again, they're no longer listed as in deferment. Same principle.
So I guess the one big takeaway that I'm hearing from both of you is that a consumer really needs to be in constant communication with their servicer or their credit company, or the company, the creditor, during any time of financial unrest.
Yeah, if I may add just quickly, and I'm sorry for interrupting, but what the most common issue with late payments associated with forbearance or deferment, which we commonly see with student loans, is people are confused about the date ranges, when they actually need to make a payment again, when they're no longer in forbearance, when that payment is due. That's when the late payments typically happens, is people say, well, I didn't realize that my payment was due. So being informed as to the date ranges is what's most important, and obviously not being late, of course.
Well, then that actually supports what I was just going to say, that the communication with the servicer is absolutely essential. And that communication needs to be before you enter into a forbearance, so that you understand the terms that you're agreeing to with respect to forbearance, during the process of forbearance, so that you can modify as your needs change and keep your servicer in the know about what your financial needs are, and let them work with you. And then ensure that you speak with them after the forbearance period to make sure that it's properly reported, that you've met your end of the bargain, and quite frankly, your servicer has met their end of the bargain. So I think that's really the most important thing that we can tell anybody. This forbearance is not something that should be taken lightly. It can have significant effects on your credit if it's not properly managed during this period. And I think that if the last few minutes have told us nothing, that is the magic takeaway. Sarah, Aubrey, I really can't thank you enough for your invaluable information and your insights today. And to you out there who are watching, if you should have any questions about the information that we've presented today, or about where to turn for help, please make sure we know you contact your mortgage servicer, but also please feel free to contact the MBA of New York. We've set up a separate email address for your questions. You can reach out to askmbany@mbany.org. That's askmbany mbany.org. In the meantime, please stay safe, stay secure, and stay smart. Thank you.
Thank you.
Thank you.